Welcome and good afternoon. I'm Jim Niedzinski from Planning Alternatives, and we're pleased to have you for Outlook 2017 webinar. We're going to share investing insights, planning strategies, and our perspective on key financial issues for 2017 and beyond. So thank you for joining. Before we begin, I would like to introduce three of our newest team members that joined us last year. We have Julie Hall, the Director of Financial Planning, Jim Long, our Senior Research Analyst, and Karen Larson, Director of Brand Experience. Let me just say that these three are brilliant, and I've enjoyed working with them, and we're so glad they've joined the team. So I look forward to you meeting them when you visit our office or speak with us. Also, before we begin, I want to share with you, if you haven't heard, that we were the humble recipients of a significant award last year issued by Charles Schwab called the Trailblazer Impact Award in recognition for really our outstanding work. And we share it with you to say thank you, because you, our clients, are who makes us who we are. Also to give you a confidence that you've made a great choice, that you've partnered with an award-winning and outstanding firm, and so we're very thankful to receive it. We also share about the award because part of the recognition is a donation made by Charles Schwab in an amount of $15,000 to the charity of our choice. And we have a long-standing relationship with Variety, the children's charity. We were so pleased to direct that donation to them. Encourage you to look into Variety if you haven't before and learn about all of the significant work they do serving children in Southeast Michigan and beyond. Before we start, just a brief slide on disclosures, essentially saying that the information we're sharing today is, of course, general in nature. We want to meet with you one-on-one to assure that the counsel we offer is specific to your situation. So let's begin. Again, I'm Jim Niedzinski, a wealth advisor here with Planning Alternatives, and our two new team members will be joining me to share with you today. We'll start with Jim Long, and he'll be sharing investment insights, and then Julie Hall will be sharing financial planning strategies. I will serve as moderator, perhaps making a comment or two or asking a clarifying question. So why don't we begin? Jim, would you take us away and give us your thoughts and perspectives?
Thanks, Jim, for the introduction, and thanks to everyone joining this afternoon. It's great to have you with us. We are in interesting times these days, not only with the normal spots around the world that demand our attention, but more and more these days, it seems like the United States is the center of the universe with the new administration a month old. The next slide just is a word cloud of several different thoughts and feelings and proposals happening these days. There's so much information being thrown out there these days that it's hard to kind of keep track of things. Our goal today is to bring you some measure of clarity in these times. I'll do that today with a brief review of 2016 investment performance. We'll talk about our thoughts on 2017 upcoming, and we'll finish off with a few things that our Planning Alternatives clients can do to navigate through these times. Let's get started. 2016 asset class, we borrowed from our research partner, Ned Davis. They termed 2016 performance a three-act play. If I would have had this discussion with you at this time last year and told you that stocks would have been up over 10% for the year, I think people would have laughed me off and thrown things at me through the microphone. At this point last year, we were down almost 10% for the year on S&P 500 performance. This was due to several things, notably Chinese slowing of their economic growth and a fall in the price of oil. But we recovered quickly through the spring time, only to set us up for the second act, which was the Brexit vote of the United Kingdom to leave the European Union. Had a sharp decrease, but through the fall time frame, we did have a significant rise again, which led us to Act 3. Of course, the United States presidential election, and the week before had another sharp decrease. But after the results were clear, over the last 6 to 8 weeks of the year, we saw record growth and record highs on the U.S. stock major indices. On the asset class level for 2016, domestic stocks, and keep in mind that this performance slide shows the broad-based class, not spreading it or not breaking it apart into component pieces of small, medium, large. But US stocks as a whole, up over 12% for the year. International stocks, 4.5% for the year 2016. Alternative assets, as measured by a mix of natural resources, commodities, and real estate, were up significantly. Keep in mind they had significant negative performance in the year to 18 months before 2016. Alternative strategies, which we'll talk about a little bit more later on in the presentation, up marginally. And bonds, even though a significant fourth quarter decrease, still finished positive for the year at 2.65%. Breaking that down into a more granular level, for example, the US stock market can be broken apart into small, medium, large size companies. I like this, we call it the quilt chart, that shows you the various asset classes and how they've performed over the last 10 years. The reason I like this so much is it defines and shows you the benefit of diversification. You'll notice that an asset class that performs up at the top of the chart in one year, just as often as not, might slide down very close to the bottom of the chart for the following year. So it's not something that you put all your eggs in one basket. And I like to highlight the line running through the relative middle of this chart, which shows you a diversified mixture as a moderate overall portfolio that touches on each of the asset classes and tends to give you a little smoother ride over time. You're never all the way at the top of this chart. You're never all the way at the bottom with a diversified mix in the moderate portfolio. It evens out the ups and downs. Now that we've spent a few moments on 2016 and what happened in the past year, let's share our thoughts on the upcoming year for 2017. I mentioned before, the US seems to be the focal point of the world these days, and there's so much from various proposals to presidential tweets at 2 in the morning. This slide shows but a few of the initiatives that may be on the agenda for this year. Some are beneficial for economic growth. Some maybe would tend to slow down economic growth, and we'll review these a little bit further. My main point here is until pen meets paper and we know some of the details on some of these initiatives, we're still in kind of a wait and see mode with the new administration. For those joining us that experienced the 70s and 80s, interest rates were very, very much higher than they have been since the most recent economic recession that we found ourselves in the last 8 or 9 years. Almost a zero interest rate policy. Most experts would think that we're in line for another 2 to 3 short-term interest rate hikes by the Federal Reserve. In their mind, and trying to read the testimony even today of Janet Yellen of the Federal Reserve, they're trying to normalize interest rate policy a little bit more from the last 8 or 9 years where we found ourselves. That's a normal byproduct of the market economy, to have interest rates and the Federal Reserve pulling the levers to try and normalize their interest rates a little bit more. We do find ourselves at the maybe tail end of a long-term economic expansion. Since 2008 and 9, the most recent recession, the US economy, and it is a cyclical economy, has been in a period of sustained economic growth, although a little bit lower than typical as far as the US GDP growth goes. This slide will show you, of the course of the 20th century, the recessionary period as well as the economic expansion. And the expansionary period we find ourselves is the second only to the 2000s with as far as the length of time that it has been in. Normally that would be a red flag. The longer you are in an economic expansionary period, the more you tend to think that, well, we're going to get to the close to the end of this and we're going to head into the next recessionary period. The next slide is something that I want to show that maybe gives us some hope that we still have some room to run with this most recent economic expansion. Over the past 50 years, the US economy has grown at a 3.1% average rate. Over time, we've had a pretty close relationship with this growth trend until the most recent economic expansionary period. We've grown at below 2% economic growth over the last 8 years since the most recent recession. So while we've had a prolonged period of economic growth, compared to the trend line over the last 50 years, it has not been as robust as we've been accustomed to in the United States. So while we've had a high number of months and years of the economic expansion, to fill this gap in the economy where we would normally be based on the trend line growth, I feel that we still have some room to run with this current economic expansion, and that a recession in the near term time frame is not really a high likelihood event. I mentioned before, until we get details on some of the policy initiatives, it's hard to really make a prediction on what's going to happen in the near future, but I'll just talk for a few moments on several of these. Regulatory reform. Most people would say that if you take limitations and restrictions off of business, they would tend to produce a little bit more. That would be expansionary or help to grow the economy. Same thing on infrastructure spending. If we're spending things, whether it's a pure government spending on bridges and roads and highways and airports, or whether it includes some sort of private initiative there as well, that would also be a signal for economic growth. Protectionism policies, which was a hallmark of the administration while he was campaigning, as well as immigration policy, if those are not thought out well and are not implemented properly, that can tend to retard economic growth. You've seen in places like Japan and Germany, maybe with immigration policy that is not maybe well thought out, the labor force tends to decrease and you have some struggle with trying to replace workers that are retiring. Finally, we've been promised supposedly details on the tax policy within the next couple of weeks. We'll see if that comes to fruition, but both corporate and personal tax reform seem to be high on the initiative or high on the agenda. If those, and I think it's maybe one point of agreement between Democrats and Republicans that the tax code is just so convoluted. Obviously, the devil is in the details on how you fix this. If there's any by miracle some chance at compromise on all sides in tax reform, making it simpler and fairer, I think that that's going to be something that's going to help economic growth. Inflation. We've had several clients ask us about inflationary forces here in the upcoming year. Again, those that lived through the 70s and 80s would kind of scoff at the notion that inflation is rising and has some sort of distinct problem for the economy. We're nowhere near the levels that we were in the 70s and the early 80s. Inflation, we've been kind of worried about deflation or negative inflation since the last economic recession. If anything, a modest rise in prices or inflation over time is kind of a normal byproduct again of a market economy. Only when you outpace the 2 to 3% long-term average on inflation will the Federal Reserve, in my opinion, start to take action to really curtail the inflation. They're watching things like wage growth of earners, they're watching things like the economic output and GDP growth, and the Federal Reserve manipulates short-term interest rates to also fight inflation as well. But we're nowhere near the point where we need to be concerned, in my opinion, about inflation moving forward. What are some sectors on both stocks and bonds that we're keeping an eye on for 2017? As far as the stock market goes, I mentioned earlier, you can cut and slice this as many different ways as you would like. But small size company stocks, most people, and they had a tremendous run up in the last 6 to 8 months of 2016 and participated fully in that stock market record highs of the end of 2016. But most small size companies have the majority of their profits and earnings within the borders of the United States. They're more apt to be helped by business and corporate tax reform. And the dollar being strong like it is would tend to benefit those small size companies rather than your large multinational corporations. Think Coca-Cola, that have large profits and earnings overseas. A strong dollar would tend to have them a negative effect when they bring those earnings back home. Other sectors that we feel are, and this is again based on some of the thoughts and proposals from the administration, but energy, financial companies, and defense sectors are also things that we think are poised for growth. On the bond side of the equation, it's a challenging time for bonds potentially with the specter of rising interest rates in 2017. Typically, bond prices or existing bonds go down in value when interest rates go up. But there are some ways that you can help mitigate these risks. One would be a little bit of an increased exposure to high yield or companies that issue debt that pay a higher interest rate. In the time of a rising economy or of economic expansion, there's a less risk that those companies will go default and won't be able to pay their obligations. And the fact that they pay a little bit higher interest rate helps mitigate the risk that the price of their bonds will go down if and when rates rise. How are we positioned at Planning Alternatives? Certainly we have broad exposure to those sectors that I just mentioned that we're keeping an eye on, but we stand committed to globally well-diversified portfolios across asset classes. So that means various stock holdings, various bond holdings for those that have them, alternative strategies within the portfolios. But even within the asset classes, we have exposure to, for example, US small, medium, large size companies, companies that have high dividend payouts. In international markets, we have not only the developed countries of the world, but those that are still emerging or developing. So we're diversified across asset classes, and we're also diversified within asset classes. As mentioned on the previous slide, it might be a challenging time for bonds. Although interest rates have kind of stabilized a little bit, most people are expecting the next Federal Reserve rate hike in June. That's kind of been the consensus that I've seen. But in an higher interest rate environment or a rising interest rate environment, why still have bonds in the portfolio? In my opinion, it's important to step back and take a look at what bonds are trying to accomplish. We're trying to reduce overall portfolio risk. Just like in times of negative stock performance, we don't suggest taking everything out of the stock market. In times that might be negative for bonds, we don't say take everything out of bonds. We want to help you reduce the overall portfolio risk by having exposure to bonds. But we've decided as a firm to allow our bond fund managers to have more discretion on choosing how they invest their funds. So that's called active management instead of just following a bond index. This is beneficial because those bond managers are very well versed in trying to determine what the prognosis will be for 2017 and how to perform best in a rising interest rate environment. Alternative strategies for those in our tactical portfolio, as I showed on the 2016 performance slide, they did not perform as well as some of the other asset classes in 2016, albeit still positive for the year. But again, taking a step back, what are the alternative strategies trying to accomplish in the portfolio? They're seeking to give you a different measure of return that's not well correlated or doesn't move in tandem with stocks and bonds. This gives us an opportunity to diversify even more fully the portfolio and hopefully participate in some growth in some of these other places of the markets that are not, again, well correlated with stock and bond performance. A couple of things about the Planning Alternatives portfolio. We do have, relative to our benchmark, a slightly higher allocation to small size company stocks, again, hopefully to take advantage of the 2017 performance that we anticipate. I mentioned the way that we're mitigating some of the risk of rising interest rates on bonds is that our bond positions have active management, and we allow our managers discretion. They have, in 2016, outperformed the benchmark, so we feel confident with the funds that we've chosen. Our stock market funds, we are neither overweight nor underweight in our tactical portfolios for those that are there. We just feel with the uncertainty and until the details become a little more apparent that we're not prepared to make a call over or underweight, but we stand at the ready to make that call based on events as they unfold. Before I close up with a couple of things that our clients can do to position themselves for 2017, I thought it'd be helpful to look at our highest bond holding and stock holding. In the firm, our largest stock position that we have is the iShares S&P 500 Exchange Traded Fund, or ETF. This is our single largest holding in our portfolio. It gives you exposure to the 500 largest US stocks. We've made a decision as a firm that our stock exposure should be in very ultra low cost exchange traded funds to give us broad market exposure and still be cognizant of funds. So the expense ratio, or the operating expense of the S&P 500 iShares ETF, is 0.04% annually, which is remarkably great compared to the average actively managed stock fund of 0.89%. But even when you compare it to the average indexed stock fund of 0.12%, we feel it's important, obviously, to provide our clients with well-diversified portfolios, but also we want to keep in mind expenses. The single largest bond holding that we have in the portfolio is the Loomis Sales Core Plus Bond Fund. Again, we've given our bond fund managers more discretion on selecting and choosing rather than just matching an index. But even when we have this active management, which typically has a little bit higher expense, when we compare the Loomis Sales Fund to an average actively managed bond fund, it still comes in under par there. Again, we're comfortable with the managers that we've selected. We think they're doing a good job, and they give us the benefit of having a little lower cost for our clients. What can our clients do to help navigate through 2017? First and foremost, we suggest reviewing your risk level with your advisor. Whether we need to take up the risk level or reduce the risk level, it's a great time to speak with your advisor about these. Prepare for anticipated withdrawals. If you know that in 2017 you may need a certain amount of money for a one-time expense or for increased ongoing expenses, it may be worthwhile at a stock market record high that we find ourselves in almost on a daily basis to take some of that profit or gain off the table and set it aside for known needs in 2017. The third bullet I try and term the Jim Cramer rule. I love well-informed clients. However, if you're watching CNBC 24/7 and any sort of news that comes forward or anything that Jim Cramer says out of his mouth, and we feel like we need to take action on it, I try and dissuade clients from feeling that way. Again, I love informed clients, but feeling that we need to act on the most recent news bite or news piece of information, I try and counsel clients against that. We feel the best way to mitigate the risks and the vagaries of the stock market is to stay in tune with your long-term plan. Come in for a meeting with your advisor. If we need to adjust the plan, great. We have the abilities to do that with you. But stay committed to the long-term plan that we do with you, and that's the best way to stay in charge of what's happening in 2017. So to wrap up my portion, again, 2016, a 3-act play. You would have laughed me off the microphone last year if I would have said that stocks would be up over 10% for the year, but it's just a way to say stay the course and stay committed to your long-term plan. Until pen meets paper on administration policies, keep in mind that we don't know exactly what's going to happen, but we are anticipating some details forthcoming and we'll make some adjustments after that. 2017 outlook, stocks seem poised for growth. Again, almost record highs every day, but we'll see what continues to happen. And bonds, there might be headwinds, but there might be opportunities within the bond sector. What should you do as clients? Stay committed to your long-term plan is the biggest thing that I would suggest moving forward. So Jim, thanks for the introduction. We'll turn it back to you for the next period.
Thank you, Jim Long, for walking us through. Much appreciated. And we're going to turn now to discuss financial planning. Julie Hall, to whom you were introduced earlier, is going to lead us through that. She's going to tell us what are some key planning developments we need to keep top of mind, and what are some strategies we might be able to take advantage of, both new and emerging as well as time tested. So Julie Hall, thank you. Please take it away.
You're welcome. Well, we recently reviewed a Fidelity couples retirement study, and nearly 3/4 of those couples surveyed said that being able to afford unexpected healthcare costs in retirement was their top concern. However, only 22% of the couples that were surveyed had actually factored that into their financial plan. So we're going to talk about this today. We're going to talk about planning for healthcare costs in retirement and the process that we have here at Planning Alternatives to make sure that we're planning for those costs accurately in your plan. In addition, we know that 2 top agenda items for the new administration are potential repeal of Obamacare and comprehensive tax policy reform. Many people are wondering what the potential tax reform could mean to them and what they should be doing now. So we plan to go over this as well. So with that being said, let's get everybody excited and talk about taxes. So in the months leading up to the election, tax policy really did not emerge as a top tier issue, but we certainly know that now it's a top agenda item. And I think we can all agree that our current tax code is confusing. The last significant tax reform was in 1986. So let's take a look at the potential changes. So right now, currently, we have a 7 tax bracket system, potentially going to a 3 tax bracket system, with the lowest tax bracket now 10% and the highest 39.6%. And comparing that to 12% being the lowest and 33% being the highest. In addition, the alternative minimum tax. Who understands the alternative minimum tax? It's very confusing. Potentially, that may go away. We also know that right now, there is the net investment income surtax, which is imposed on couples married filing jointly who have $250,000 or more of income. And there's also the Medicare surtax. Again, applies to couples married filing jointly with $250,000 of income or more. Both of those potentially may go away with the reform. We know currently that there is an estate tax for states that are valued above $5.49 million. Potentially that will be repealed. In addition, lower corporate business tax rates. So to summarize overall, lower tax rates across the board. How are they going to do that? It's always a give and a take. Changes to personal exemptions, standard deductions, itemized deductions, and obviously we've got to wait and see how things progress over the year. So let's take a look at a very nice graphic by Michael Kitces that can illustrate the current versus the potential changes very clearly. So again, here you can see married filing jointly and individual current tax brackets. There are 7, and the proposed potentially going to 3. And overall, across the board for married couples filing jointly, taxes are going to be about the same, if not lower, with the exception of those in the 10% bracket. They would be going up to, a portion would be going up to a 12% bracket. And for individuals who have income between $112,000 and $198,000, potentially are going to see an increase in their taxes. So while we're waiting, what can we do? So if you have the potential for a higher tax bracket based on the changes, you might want to accelerate income this year, because if your tax bracket is going to go up, accelerating income now at a lower tax bracket might be an optimal solution for you.
So Julie, if I understand the chart right, at the top in green is the existing tax bracket.
Yes.
I see below in tealish is the proposed. So if I'm understanding, that gold section is that small sliver where someone in the 28 might end up in a higher bracket?
That's correct.
Yes, okay, good, please continue, this is helpful.
Yes, and if there is a potential for a lower tax bracket, so that would be in the blue on the chart here, then deferring income might be a good option. Because if you're going to be in a lower tax bracket next year, you might want to defer and realize income next year when you're going to pay at a lower rate. So who might be able to do that? Well, business owners may have the ability to do that, key executives, and retirees, potentially.
If I'm a retiree, I could delay an IRA withdrawal, or if I'm an executive, I could perhaps delay or accelerate the realization of a stock option income, for example. Okay, that's good. Thank you, Julie.
Yeah, so I mean, a retiree who maybe they've wanted to take that Viking cruise and they've been, trying to decide when is the time to do it, now might be the time to take more out of the portfolio if their tax bracket is going to go up next year. And Roth conversion. So Roth conversions, if potentially you're going up into a higher tax or a lower tax bracket, if you're going to have a lower tax bracket next year, maybe Roth conversion has not been something you've been able to take advantage of, and potentially you can. And if you are in the 25% bracket or below and will continue to be in with the potential changes, then Roth conversion may still be an optimal strategy to continue to do now. Overall, we recommend that you meet with your tax professional and your financial planner to have your specific situation reviewed to see what makes the most sense for you. Most experts expect the first year that we could see this change, and the first tax year that we would be affected by the change would be 2018. So now let's talk about some timeless tax planning considerations. So no matter what happens, these are some tax planning strategies that can be considered. And because there haven't been a lot of changes for tax year 2017, these are things that we've been talking about in prior years. Again, schedule your annual review. We talked a little bit about Roth conversion planning. If this has been part of your strategy and you're in a 25% bracket or below, it still may be an optimal strategy. And converting earlier in the year makes good sense because you can always recharacterize that conversion later, and it gives more time to decide whether or not it made sense to do the conversion in the first place. In addition, portfolio loss recognition, so continue to harvest losses if that's something that you can do based on your situation, is still an optimal strategy to consider. And gifting. Let's talk about gifting. So let's talk about the basics, the annual gift exclusion. So each year, a person can gift $14,000 per year per individual. Grandpa could give $14,000 to Jane. He could give $14,000 to Joe. And he could give $14,000 to Bob the barber. And he would not have to file a gift tax return. So let's take a look. Let's say Grandma wants to fund a 529 plan for her grandson, Joe. She can actually gift $14,000 this year to that 529 plan. And if she wanted to superfund that plan, a 529 plan has a special rule where you can use 5 years of your annual gift exclusion and put that into a 529 plan. So in 2017, Grandma could fund Joe's 529 plan with $70,000. And that is taking that $70,000 out of her taxable estate and the growth. And, is creating a very nice gift for her grandson, Joe. Grandma and Grandpa together could max fund the 529 plan for Joe. So they could each use their $14,000 annual gift exclusion. Again, they can max fund that 529 plan, putting in $140,000 in 2017 into Joe's 529 plan. Again, getting that growth, those dollars out of their estate as well as the growth, and giving a very nice gift to Joe of education. Let's say that Joe is actually going to college now, and there isn't a 529 plan set in place for Joe. Grandma and Grandpa can actually write the check directly to the educational institution for several $1,000s, as long as it equals the cost of the education expenses. There's no maximum for this, and they are not using any of their annual gift exclusion. Donating highly appreciated stock, still a very good strategy. Let's take a look. So let's say you have a stock in your after-tax portfolio and you paid $25,000 for this stock, and it has $75,000 of appreciation, so it's worth $100,000 today. And let's say you're charitably inclined. You could give that stock to charity, have a potential for a tax deduction, and you get to eliminate that capital gain tax completely. You do not have to pay it. Let's move on and take a look at a donor advised fund. This is an excellent way to give to charity, setting up a donor advised fund, giving cash or assets to that donor advised fund, having a potential for a tax benefit. And the beauty of a donor advised fund is you actually get to get those dollars out of your estate, get a tax benefit, and you get to control over time essentially where you want those dollars to go. For instance, if you want to set up a scholarship fund and annually decide who would be the recipient of that, you get to do that. And let's talk about qualified charitable distribution. So if you're over 70 and a half, actually this was made permanent last year in December, an individual over 70 and a half can gift up to $100,000 each year from their IRA, and that can also satisfy their required minimum distribution, and they can give that to charity. So let's take a look. If you give $100,000 from your IRA, and let's just say that your required minimum distribution is also $100,000. If you were to take your required minimum distribution as income, you would have that income for yourself and you would pay tax on it, and let's say you're in the highest tax bracket. But let's say you're charitably inclined and you want to give that $100,000 to charity. You can have the check sent directly from your custodian to your charity, and you will not pay any income tax at all on that $100,000. It's completely excluded from your income. So this is an excellent way to satisfy your charitable planning goals. All right, we are done talking about taxes, and let's move on to healthcare. And if we don't plan properly for healthcare, we can forget about all the tax planning topics that we just discussed. So let's move forward. So let's take a look at a 30-year retirement period and a typical spending pattern that we see during that time. So initially, in the first 10 years of retirement, we call this the go-go phase. You're very active, you're traveling, typically spending 100%, maybe even a little bit more than your pre-retirement spending needs. Then when we get into the second phase, we call this the slow-go phase. So this is the next 10-year period of time. And initially, you're traveling, very active, still going to see children in different parts of the country, different parts of the world, but during the second phase, things start to slow down. Maybe you're not traveling as much. And we typically see over this period of time a 20 to 30% reduction in spending during this period. And then we move into the third phase here, the next 10 years, and we call this the slow phase. So typically slowing down, not traveling as much, becoming more of a homebody, spending time with family. But what we do see during this time is a dramatic increase in healthcare costs. And healthcare costs are inflating at a much higher rate than all of the other costs in retirement. So let's talk about Medicare. Now we're going to transition to Medicare costs, which is one of the healthcare costs we're going to talk about today. So let's look at the rising healthcare costs of Medicare. So here we're looking at Medicare Part B premiums as well as Medicare supplements. So at age 65, somebody can expect to be spending around a little over $4,000 a year in Medicare costs at this time, with Part B and supplements. At age 85, with a 6.5% inflation rate, with Medicare Part B and supplements, we could see an increase of over $18,000 a year just for Medicare in retirement. So we want to make sure that we're planning for these costs appropriately in your financial plan, and we have a process to do that. In addition, let's dig a little bit deeper here, and many of you may have experience with this already, but Medicare Part B premiums are now based upon your modified adjusted gross income. So your modified adjusted gross income in 2017 will determine your Medicare Part B premiums in 2019. So let's take a look at a specific example here. So let's say that Mrs. Client has an annual spending need of $110,000 a year. Her Medicare premium is $267.90 per month. But Mrs. Client is wanting to do some renovations to her home because she's starting to think about health care, long-term care as she ages. And so she wants to renovate her home so that she can stay in her home as long as possible. And that's going to cost $120,000. And she calls up and she wants to take a distribution from her IRA to meet that expense. Well, what's going to happen in 2019, she's going to have an increase in her Medicare Part B premiums. And if that's important to her, we want to hit the pause button and see if there's a better way to plan for that renovation, a more tax efficient way to meet that cost. So maybe we want to make sure, number one, that she's on the cash distribution strategy here at Planning Alternatives. And we want to make sure that we're pulling as tax efficiently from the portfolio. Maybe a home equity line of credit might be something she should consider, or refinancing her mortgage. Or maybe she has excess cash reserves that we've been talking about over the past couple of years, and she should utilize that to help meet that expense, to keep her Medicare premiums down. So let's move on to long-term care expenses, which is another potential healthcare cost in retirement. So long-term care planning. So here we're looking at a chart. We're looking at a statistic here for long-term care. Married couples age 65 plus. So the woman has 73% chance of a long-term care event, and the man has a 35% chance of a long-term care event. So we need to, again, make sure that we're planning for these long-term care expenses in retirement. And again, women can expect to pay more for healthcare in retirement because we live longer. So we go to the doctors more frequently, and unfortunately, ladies, this is what we get with those extra years, possibly a long-term care stay. So let's take a look at our financial planning process. And many of you may have gone through this process, maybe some of you haven't. But we take a look at all of your assets. We take a look at all of your income sources, and we take a look at your spending need. And we want to make sure that you're not going to run out of money. That's our goal when we're going through a financial planning process, number one. And we run 1,000 different trials, 1,000 scenarios. And we want to see 80% or more of those trials successful, meaning that you did not run out of money. So let's take a typical scenario here. This client has an 88% probability of success, meaning 880 of those scenarios were successful. So that's good. We want to be in the green zone, and this client is in the green zone. Once we've gone through that process, then we take a look at the what are you afraid of section of our financial plan. And no, we're not talking about heights, snakes, or clowns. We're talking about the real scary things that could affect our retirement, such as a great recession loss, inflation, Social Security cuts. Today, we're talking about healthcare and long-term care expenses. So again, here we took a look at assets, income sources, and spending. We did not take a look at a long-term care event. So when we factored that in, let's take a look. So we have assumed a 3-year long-term care event at $85,000 a year, growing at 6.5% inflation rate. And here you can see that when we factor that in, this client is no longer in the green zone. So we've got to put a plan together to make sure that we plan appropriately for these expenses. So what are some things that you can do? Well, number one, meet with your advisor and have your annual review, and let's make sure that we have been planning appropriately for these costs. If you're still working, you may want to see if you have the option to establish a health savings account through your employer. This is a great account. You can save on a tax favored basis, so the money that goes in goes in pre-tax. You're not taxed on those dollars. It grows tax deferred, and as long as you use those dollars for qualified healthcare expenses, it's tax-free when it comes out. Review your healthcare coverage annually. So if you're already on Medicare, we partner with professionals who can analyze your current Medicare programs to make sure that you are not paying too much for your Medicare. Take advantage of the benefits available to you. If you are paying for long-term care premiums, and if you have a health savings account, you can actually pay for long-term care premiums from your health savings account. And if you are already paying for long-term care insurance, or you are considering paying for long-term care insurance, review the tax deductibility rules with your advisor and with your tax professional. Business owners, review the deductibility rules for long-term care premiums. So depending on the type of business structure that you have, there are different rules for deducting long-term care premiums. So in summary, again, meeting with your advisor, with your tax professional to analyze your specific situation is the most important takeaway.
Julie, Jim, thank you for sharing. It was excellent. I have a page of notes, and we also have received a few questions. We do have a few minutes left before we have to leave, so on your panel, you'll see a section where you can type in a question. If we have the time, we'll be happy to answer. One of the questions we received was about gifting. We talked about being able to donate to charity or gift to individuals. So the question came, is that ability to gift, using the exclusion you mentioned, Julie, the $14,000 per person, is that limited to who it can be gifted to? Does it have to be family, kids, or grandkids, or can that go to anyone?
The $14,000, that can go to anybody.
Including Bob the barber.
That's right.
All right, so that is not a limitation. Another question came in about long-term care expenses. Question was, you mentioned a projected $85,000 per year long-term care expense. Why did you pick that number? Where did that estimate come from?
So we use that estimate because that is fairly close to the U.S. average for long-term care expenses.
So I understand it varies by location and by state. Maybe it's more expensive in Manhattan and less expensive in Louisiana. Also, what's the quality and nature of the room or the care given? So, but that's a national average, you say? Okay, great. Another question had come in about will this presentation be available? And in fact, this webinar will be posted on the website tomorrow. It'll be available to listen to or forward or share, so you'll find it on the Planning Alternatives website. Pausing for just a moment to compile any other questions. Okay. Well, of course, you can reach out to your advisor with any questions. We'd be happy to talk. What's next? Well, we presented this live here locally a few weeks ago, and we're presenting live next week in Fort Myers, Florida. So if you're in that area or know someone who is, please let us know. We'd be happy to have you join. Also a reminder, this fall, our annual client photo contest is scheduled. We had such a success last year. I please ask you to come join. It is tremendous fun, whether you submit a photo or not. If you are going to submit a photo, the theme is inspiration. Inspiration. So be inspired, find a great photo, be prepared to respond to the invitation to send it in for the contest. Well, that's it for us today. Thank you so much for joining, and all the best in 2017 and beyond.